Now, today specifically, we're going to talk about old home buying strategies where you essentially pay off your home in 15 years, right? And then we also want to talk about new home buying strategies where essentially you pay off your home in 15 years, but you come out on the other side with much more assets and much more things, right? Than you ultimately will with the old home buying strategy. And both of these strategies is something great. And if it's something that you can afford to do and something that you can qualify for accounts like those, then it'll be great. But probably one of the biggest things that I need to teach you first is about just some of the other ways that people ultimately pay off and buy homes. So, for instance, a lot of people, they'll take out a massive home loan for, I don't know, we'll go $350,000, right? A $350,000 house nowadays, depending on where you live, might get you a good bit of stuff, but also depending on where you live, will get you very, very little things. But a lot of times they'll go ahead and get their home. They will take out a loan, as well as manually pay a deposit. Hopefully they pay a deposit. Now, I have worked a lot with veterans as well with a lot of these home buying strategies. So I have a lot of experience with like utilizing a VA loan. Now, if you are a veteran and you have not used your VA loan before, and you kind of want to know some of the strategies, today's also going to be really perfect. So if you are watching and you do know a veteran, make sure to pass this along to them and then pass them along to me so I can help them out with carrying out this strategy. And here's a cool thing. Again, complimentary. Everything that I do is complimentary. The education that you guys get here is complimentary. I'll never be locked behind a paywall. The education that you get in one-on-one consultations with me and my firm that I've created and built, you would also never have to worry about any kind of fees or payments or anything like that, right? Even the strategies that I built. So you don't have to necessarily worry about that. Just get you information. So anyway, this would be great for a lot of them as well, because many of them, they take out a VA loan, home loan, and they don't put anything down, which increases their mortgage and likely also probably increases their interest rates as well. And so they do that and they pay off the home for 30 years. As far as the old home buying strategy, and I actually have some visuals for you guys. So I'm pretty excited for you. Now, like I said before, do understand that I did create this for military, because it's created for military at a basic standpoint. However, this can be applied anywhere, right? So as far as the old versus new home buying strategies, this I want to be able to show you today. So with old versus new home buying strategies, when it comes to military service members, when it comes to you buying a home, so many people want to put down like the minimum amount that they possibly can, so that way they don't have to come out of pocket with so much money, right? They save up to like just a little bit. How much is enough? Well, if you're less than about $750,000 for a house, definitely putting down like 20 is good. And if you're anything above that or above $1 million, 25 to 30% is like much more of where you want to be at. All right. But with that being said, here's the big thing is that if you don't put down a significant amount of money, your mortgage payment will be much higher every month, which then decreases your cash flow, which let me give an example. If you have $2,000 a month of income, of discretionary income, and your mortgage is now $1,500 because you didn't put as much money down, now you've only got $500 left to be able to save and put away or whatever the case is. Versus if you had $2,000 a month and you did put a significant amount of money down, maybe your mortgage payment is now $1,300. Now you've got $700 left to be able to play around with. All right. So that $700 to play around with will ultimately do more than without, right? And so old home buying strategies, old versus new home buying strategies. We're going to talk about the old strategy versus the key differences, new strategies, and then also how you can be able to get some good retirement income out of it. So this is my good dear friend Jane Doe. She adopted not her, but her family adopted my brother John Doe. Now, Jane used her VA loan and put $0 down for a house. Now, her and John both bought a $350,000 home, right? Now, she's planning on buying her home for the last 5 years. She had about $1,000 of what's called discretionary income, which is the amount of money that she has left over after she pays all her bills, right? And that includes her mortgage and things like that. And so because she did not put a significant amount of money down on the house, her mortgage payment is higher, but she then gets to keep the money, at least that she saved up over the last 5 years. So what does she do with that extra discretionary income? Well, her current situation now, like I said before, she has $1,000 of discretionary income, $1,000 to be able to do whatever she wants with. So she decides to pay an extra $850 a month to her minimum mortgage payment, totaling $3,415 that she's paying a month. Actually, yeah, that much money. I'm looking at this. I'm like, yeah, that doesn't add up to that, but I think I did. Let's see. Let me make sure. Okay, yeah. So probably some pennies. There we go. So anyway, now because she paid extra to her mortgage, she was able to pay off her mortgage 15 years early after only 15 years of paying for her mortgage, which is amazing. This is a pretty good home buying strategy that people used to use, right? Now they would put, minimum down, but they would take all the rest of their discretionary income and put it towards buying their house, which I 100% understand. Makes a lot of sense. Now, what happens after that? So once again, she is, a military service member, and so she has access to Navy Federal. Now, Navy Federal savings account is growing at point. So she's putting her money into those savings account. Now, over the last 15 plus the 5 years that she prepared, she came out of it with $90,000 saved up and her home equity of $373,000, which is a pretty good situation. That's a situation that a lot of people find themselves in, which is awesome. Right now, the first 5 years, here's just to kind of explain what happened, with like numbers in the background. The first 5 years, because she had $1,000 of discretionary income, she saved $1,000 a month for 5 years, which if she adds $12,000 a year into her Navy Federal account growing it, after 5 years, the total value of that account would be $60,451. Right? She's gained $451 over the last 5 years from interest, which is decent for a lot of people, right? Especially if they are able to save that money. And instead of using this $60,000 for a down payment, she instead decided to just continue saving on top of that. All right. So some people are not that fortunate to be able to have a VA home loan to be able to not put down any amount of money. Right. But for the most part, a lot of people, a lot of civilians, a lot of you will be forced to take some of this money and put it down. So really, you wouldn't end up in the same situation that with $90,000 in the end. All right. Now, let's say she goes to buy the home. At this point, she has $60,000 and of her discretionary income of $1,000. Remember, she was paying $850 on top of her money, she was paying $150, $180 on top of her mortgage, meaning she had $150 left from her discretionary income. That means that she has the ability to put $150 a month into or on top of her $60,000 of savings per month or a year. She does that for the next 15 years. She ends up with $90,000 in the account. Now, this is also before inflation. If we count inflation, it would probably be about like $45,000. But dollar amount that she sees, right? And then they're talking about value, dollar amount that she sees in her account. So then this is also just the home equity prediction for her, right? Her home equity, $373,000. So what are the differences? Put a significant amount of money down. One, even, and this is also something for military service members too, or veterans. Even if you did get a VA home loan where you didn't have to put any money down, still put money down. All right. Put money down so that way it can lower your mortgage and also likely your interest. Hopefully it lowers it down just a little bit, right? In addition to that, pay only the minimum balance. That way you have much more funds to be able to put into long-term savings and growth. And then instead of paying 15 years earlier because you were paying extra, the goal is here to save that money into a market protected indexing strategy so that way you have more funds in a liquid account, right? An indexing strategy is a laser fund. A laser fund, something that's liquid, is safe, and is protected from the market, and it also has really safe and great rates of return and awesome taxation. But with that, you take that money that you've saved and lump sum pay off your another house. And also, you can buy another home if you like to. So this here is my brother, or is my son. I want to go my son, who I taught him everything I know, everything I can about money and finances and home buying and investments and debt management, credit building, all these great things. And I put him into the world to go and change and impact everything. And then the Doe family decided to adopt him, which I appreciate the Doe family for it. Thank you, Doe family. You're amazing. So he decided that he was going to do the same thing, buy a $350,000 home. But for him, it was a little bit different because, once again, even though he was planning on doing it in 5 years, he saved, him and Jane have the same amount of money, all right? He saved his $1,000 a month into his laser fund, into his indexing strategy. Now, because of this, he was able to take $50,000 out of his laser fund and put it down on his $350,000 home that he just bought. And he took that directly from his indexing strategy, which is really awesome. So because of that, once he went to buy the house, his mortgage payment is significantly cheaper and less than Jane's was, meaning that he now has an additional $300 of discretionary income available to him, which is awesome because now he can do more with that money. So he's already in a better situation just by putting more money down than she did, right? So when it comes to you and your home buying strategies, you want to make sure that you put more money down, the most money down that you can. Again, about 20%, maybe 25%. So in this scenario, though, he did not make any monthly payments, or Smart Risks pay your mortgage. He did not pay anything extra to his mortgage payment. So his mortgage payment is exactly what the minimum is. However, because he took his discretionary income and was able to put it into his indexing strategy for the next 15 years, his indexing strategy account, his laser fund, grew to over $570,000. I believe actually $576,000. And because of that, he was able to remove funds from his indexing strategy and directly pay off his mortgage. He didn't have to apply for a loan. He didn't have to wait for 2 weeks to get the cash or anything like that. He was able to just take the money directly out because it's liquid and pay off his home after 15 years. And the cool thing is the money did not come from the actual account value. So the account value is still growing at that 500. So for instance, if that account performed at 10% that year, his account is going to get credited 10%. So it's going to go up. Let's say 10%. That's $57,000. His account's going to go from $57,000 to $628,000. And that's because of the way that laser funds work, where you're able to pull money from the account without it leaving the growth of the account, which I can be able to show you here shortly. Now, he also did the same thing that Jane did, where he put the extra $150 a month towards his Navy Federal Savings account. Right? He did that as well. He did that for 15 years, and that grew to about $27,500, and he still has his home equity value of $300. Isn't that awesome? Right? He came out with much more money and the home just because he paid more money down. He only paid the minimum, meaning that he could save his money elsewhere into a laser fund. And then also while putting money into his laser fund to actually grow and be market protected, he also was able to then take that money and lump sum pay off his home. So here's the proof in the putting on there. So here's 5 years in an indexing strategy for him. All right. So as I said before, he started by doing the same exact thing. Instead of saving $1,000 a month into a federal savings account, growing at 0.25%, he put his into an indexing strategy, growing at 6%. We're going to say 6%, right? Right about 6%. And so this is the $12,000 a year, $12,000 a year for 5 years. All right. Now his accumulated value is what's growing here. Now at year 6, he goes ahead and takes out $50,000 from his $72,000. But notice the $72,000 did not dip. Only this net surrender dipped. And that's because that's where the money comes from. But this is where the money is growing. This number is where the money is growing, which then continues to increase the net surrender value. And the really cool thing is he was able to take this $50,000 out that he had saved up, and it does not remove that $50,000 from the account's performance. And also because he has more discretionary income and he's not taking that extra money and putting it towards a house, he's taking that extra money that he has, about one extra a month, he's putting into his laser fund, into his indexing strategy, which means that he's putting in per year about $14,100. And he's able to do that. And again, he's able to take this money out whenever he wants to, right? So after he borrowed that $50,000 from himself for a down payment on the house, he now is able to put $150 a month towards his Navy Federal account, just like Jane, and then also $1,175 a month towards his indexing strategy, which is really awesome. So what does that look like 15 years into the future? Well, end of year 21, right here, when he's 46. At this point, his home's value is about $200,000. And so this is where he's able to then take $200,000 from his account, from his indexing strategy here, and lump sum pay off his home after 15 years. But once again, the really cool piece is it does not remove it from the growth of the account. So he still has $576,000 in there. Now the cool thing is right here, he actually has $299,000 left to use or to take out. So if he wanted to, he could sell his current home, or he can keep his current home and still take another $250,000 out for a down payment on $1 million home. That'll be 25%. How awesome is that? And cool thing now is that because he also paid off his home and his mortgage, he can now take all of his income, his discretionary plus his monthly payments of total $3,000 a month, and put it directly into his indexing strategy and come out on top with much more money to be able to utilize for his life. So let's talk about retirement for the two of them. So Jane finally decides to start a high yield savings account for retirement. She's able to put away her full discretionary income of $3,000 a month, right? That is the initial discretionary income of $1,000 plus her mortgage payment, which I didn't put all of her mortgage payment, but she does this for another 19 years until she retires at the age of 65. And this is also another common strategy. People pay off their homes and then they look for CDs, high yield savings accounts, mutual funds to be able to put their money into, so that way they can then go and have a retirement. So she started at $90,000 in her Navy Fed account. She moved that over to her new high yield savings account, growing at 5 for 19 years, putting $36,000 in a year, or $3,000 a month. If she needs 25 years of retirement income, that means that she'll have $98,488 a year of retirement income, which is pretty awesome, right? I mean, that's a solid. I mean, again, this is also not including inflation. If we were to include inflation, this might be like $50,000, right? But she has now $98,000 a year that she can start taking out from her account because of everything that she's built up, which I'd say 2-star retirement. Let's go over to my baby brother John Doe here. However, now he started saving the rest of his discretionary income for his retirement savings for only 5 more years. And because of the compounding effect from the last 26 years of constant growth and none of this account value ever going away. And never lose $1, right? Warren Buffett, rule number 1, never lose $1, right? Rule number 2, see rule number 1, right? He's able to retire at age 51 and he's able to take out a year in retirement. And the really cool thing is these accounts are protected by insurance. So the good thing about that is if anything were to happen to you, because it's insured, any of the money that you put into the account will go back to your family if you passed away early. So let's say that he passed away before he could live out all of this retirement income. His family's going to get the rest of the money that's in the account that he put into the account. That's a really awesome piece. So he retires at 51, taking out $158,000 a year. I don't know what $158,000 a year would do for you, but I know for a lot of families that could be life-changing and help dramatically. Same 2 people, same 2 homes, same amount of income that they're getting from their jobs, same careers, and that we're also putting the same amount of money away into something, right? Jane just decided to put all of her money into the house. And then John just decided to diversify, right? Diversify his money across a couple different strategies. Because of that, he was able to pay off his home after 15 years, having much more assets, liquid assets at that, much more liquid assets than Jane had. Again, liquid just meaning he has the ability to actually take money out, put money in whenever he wants to without penalty. Man, I always love teaching that because it's so practical. So if you are looking for a strategy like that, and you would like to be able to see what those numbers look like for you, obviously you can feel very free to reach out to me either in the comment section or check out my email address, which is also in the comment section, charmick@rffinance.org. I can be able to help you out with that strategy and actually seeing what those kind of numbers would do for you, and even trying to help you get approved for some of those different laser funds and strategies. So definitely feel free to reach out for one of those complementary strategies to work directly for you, because it has to be customized. And then also, if you are in the business of finance and you're teaching other people strategies about home buying, understand that. The downside is that a 401k isn't going to do that for you. An IRA isn't going to do that for you. All right. The stock market is great. And I love the stock market because you can get really great returns. Stock market is great, but it's not going to guarantee zero loss like a laser fund will, because it is fully protected from the market. It just mirrors the stock market. All right. And that's the difference. You get really great rates of return. And then also with the stock market, they cannot guarantee any amount of money. So that's the really cool part. All right. So I hope that that's very informative for you guys. We had an awesome time. I'm looking forward to our time tomorrow, which tomorrow, let's see what we have on the agenda. For tomorrow's, we are talking about how do I double my income as a business owner? So, or how do I double my income altogether? Anyway, I'm looking forward to it. It should be a great time. Thank you guys. Remember to like, comment, rate, and subscribe as well over on YouTube. Join the community, join the team. I'd love to hear you guys' comments and feedback in the comment section below. And if you're also listening to this on Spotify, howdy friend. But you guys go and do great things. I shall see you guys tomorrow. Enjoy your Tuesday.